You're tuned in to your ultimate pit stop, Piston Pundit, where gears, grit, and global trends collide. In April 2025, the global economy hit a pothole the size of a cargo ship. A surprise trade flare-up between the US and China didn't just echo past tensions. It escalated into a full-blown logistical pileup. With tariffs soaring, ports jamming, and orders freezing across major industries, even household names like Amazon and Ford were forced into damage control. A so-called 90-day tariff truce might have sounded like a break, but is this really the cool down, or just the calm before another breakdown? From cargo routes to car lots, here are the economic aftershocks that could stall your next ride. Ports in crisis, when trade routes turn into traffic jams. In April 2025, global shipping hit a wall. After Trump imposed a sweeping 145% tariff on $300 billion in Chinese goods, Beijing responded with silence and action. Within 72 hours, US-bound exports from China dropped 47%. Major ports from Shanghai to Shenzhen jammed, while California's terminals echoed 2021's pandemic chaos. 27 ships idled off LA, with delays nearing 96 hours. Shipping rates exploded. A 40-foot container from China to Long Beach leapt from $1,950 to $6,820 in 10 days, a historic 250% spike. As China froze contracts mid-route, freight forwarders pulled bookings, and the shockwaves spread fast. Sinotrans called pricing unpredictable, and over 1,200 Dongguan factories went idle. Giants like Costco and ZTO halted westbound freight, citing chaotic US tariff enforcement. Stateside, panic set in. Amazon, Home Depot, and Tractor Supply froze orders and rerouted stock. This wasn't just a logistics hiccup, it was a system-wide seizure. But while ports jammed, a more strategic strike was already underway, one aimed at a pillar of American industrial pride. Boeing grounded, a precision strike on American prestige. Behind the scenes, another shot was fired, this time in the skies. China's Ministry of Commerce quietly instructed its state-linked airlines to freeze all new Boeing deliveries. No press release, no technical justifications, just silence. And the effect? A staggering $28.4 billion erased from Boeing's market value in 2 days. Delivery of 84 aircrafts, including key models like the 737 and the Dreamliner 787, came to a grinding halt. It was no accident. As analysts like CSIS's Scott Kennedy noted, this wasn't about airworthiness, it was psychological warfare. Boeing, long a symbol of US engineering excellence, was reduced to a bargaining chip. Meanwhile, Airbus reaped the rewards. Its shares jumped over 11% as Chinese airlines shifted allegiance to Europe. Message received: if Washington keeps turning up the tariff heat, Beijing knows exactly where to aim next. This wasn't mere retaliation, it was strategic, symbolic. And the next industrial target was already in sight, your favorite car brand. But before we dive under the hood of the auto industry's struggles, make sure to hit that like and subscribe button. It helps Piston Pundit reach more auto lovers like you. Now let's shift gears and take a hard look at how the chaos hit the road, literally. Tariffs trigger a tailspin, retail and auto on the ropes. As container traffic froze, chaos rippled through US supply chains. Five Below scrapped $67 million worth of shipments mid-transit. Amazon urged sellers to halt all incoming Chinese inventory. Consumer sentiment dropped to 75.1, its lowest since 2022. The auto sector felt the brunt. Ford's Michigan plant paused F-150 Lightning production due to missing microcontrollers from Shenzhen. GM's Tennessee battery output sank 60%, and Stellantis flagged looming EV delays tied to inverter shortages. By mid-April, over 41,000 vehicles were lost from US lines, costing $1.6 billion in delayed sales. Used car wholesale prices jumped 4.1% in a week, rivaling the 2021 chip crunch. Dealerships cut inventories by up to 30%, bracing for more shocks. Even high-end buyers weren't spared. Ford tacked $1,200 onto Mustang Mach-E prices. Stellantis hiked plug-in hybrid prices by 6.8%. This wasn't inflation by demand, it was structural. With some automakers relying on China for over 24 essential parts, the message was clear. One delayed $12 chip can stall thousands of workers. So what about shifting supply chains away from China? That path has its own speed bumps. Global detours. Why shifting supply chains still hit dead ends? On paper, cutting ties with China sounds like a fix. In reality, it's a logistical headache. By April, Vietnam's ports were running at 94% capacity, causing week-long shipping delays. India's truck-heavy infrastructure lags behind on speed, while Mexico, once the poster child for nearshoring, now sees average border waits of over 12 hours in Laredo. Big players tried to pivot. Tesla moved battery module production to Mexico, but scrambled for emergency warehouse space in Arizona. Apple's India expansion came with a catch. Defect rates 14% higher than Shenzhen. Then came the mineral crunch. On April 12th, China restricted exports of dysprosium and terbium, two metals essential to EV motors and defense tech. Ford warned of looming EV slowdowns. Lockheed and Raytheon lobbied Washington to fast-track permits for mining in Canada and Australia. But there's no quick replacement. 78% of US rare earths still come from China. Alternatives won't scale until 2026 at best. And just when it looked like global logistics couldn't stretch any thinner, Geneva delivered an unexpected curveball. The Geneva surprise. Ceasefire or just a commercial coffee break? On May 11th, US and Chinese negotiators announced a temporary tariff rollback. The US dropped its 145% import tax to 30%. China responded by slashing its 125% levy to 10% and promised to ease up on non-tariff barriers too. Markets reacted like it was Christmas in July. The S&P 500 surged 2.8%. Shipping indexes soared. Treasury Secretary Scott Bessent called it a mutual timeout from economic self-sabotage. Trump declared it a total reset. But is it? Major retailers aren't racing to restock. Amazon, Five Below, and others are still sitting on the sidelines. Blank sailings, canceled cargo trips, spiked by 300% even after the agreement. Promotions for Prime Day and July 4th were cut, not increased. Confidence hasn't returned. It's on probation. The deeper issue, trust in China's just-in-time model has cracked. Order cancellations, contract ruptures, and panic stockpiling reshaped logistics playbooks. Even if the tariffs are lifted, the damage isn't undone. As one freight CEO put it, we may reopen the lanes, but we're not driving the same route anymore. So what does this all mean for the auto industry and the road ahead? Final verdict. Is this a temporary fix or a turning point? This wasn't a trade war of rhetoric. It was fought with shipping manifests, microchips, and critical minerals. Boeing got grounded. Ford's EVs stalled. Supply chains shattered. It wasn't a policy dispute. It was a full-body stress test on global manufacturing. The Geneva Truce may offer temporary breathing room, but it doesn't rewind the clock. Automakers aren't confident. They're cautious. Retailers aren't bouncing back. They're bracing. And supply chains? They're splintered across a dozen unpredictable pathways. So here's the million-dollar question. Is this the beginning of a new balance, or just the eye of a bigger storm? Let's hear from you, gearheads and industry insiders. Do you think this trade truce will actually hold? Or is another tariff surge waiting around the bend? Can automakers realistically sever dependence on Chinese components anytime soon? And what will it take for prices at dealerships to finally stabilize? Drop your thoughts in the comments. We'd love to hear your take on this international engine block of a story. If you enjoyed this breakdown, hit that subscribe button and turn on notifications to stay tuned for the next wave of auto industry updates. At Piston Pundit, we've got the torque to keep you informed. Thanks for watching and see you next time. You can now check out any of the videos on the screen. There's plenty more to explore.